Welcome back to the MicroLearning Institute. In this short tutorial we're going to look at the December 2010 sitting of the Diploma in IFR. Specifically we're going to look at question number 3, Epsilon, and specifically transaction A of that question. In this question we're told that Epsilon is a listed entity. You're told you are the financial controller of the entity and its consolidated financial statements for the year ended the 30th of September 2010 are being prepared. Your assistant, who has prepared the first draft of the statements, is unsure about the correct treatment of a transaction and has asked for your advice. Details of the transaction are as follows. On the 1st of October 2009, Epsilon issued 5 million loan notes that had a value of $1 per note. The issue costs were 3 cents per note. Each note holder will receive interest of 5 cents per note on the 30th of September of each year starting on the 30th of September 2010. The loan notes are repayable on the 30th of September 2019 at $1.20 per note. Or as an alternative to repayment, the loan note holders can elect to exchange their notes for shares in Epsilon. On the 1st of October 2009, the credit rating of Epsilon was such that it would have had to offer investors in non-convertible loan notes a rate of return of 9% per annum on any investment. The impact of issue costs would increase the effective interest rate on such loans to 9.45%. The following information regarding discount rates may be relevant, and here we're presented with information regarding discount rates of both 5% and 9%, and we're provided with information on the present value of $1 receivable at the end of year 10 in relation to those discount rates, and also the cumulative present value of $1 receivable at the end of years 1 to 10 at those discount rates. We're now required that for this transaction to prepare extracts from the financial statements for the year ended the 30th of September 2010. The extracts should be supported by appropriate explanations. So this transaction in this question is referred to as a convertible bond, and the IFRS treatment for this transaction is that we split the convertible bond into separate debt and equity components. The debt component we'll begin with, and this is calculated by calculating the present value of the future cash flows. So for this we need to look at each future cash outflow relating to the bond, and we need to discount that cash flow to present value. The first cash outflow refers to the 10 consecutive years of interest. And again, we see from the question that interest is paid at 5 cents per note, or at 5%, and the total value of notes issued is $5 million. So $5 million by 5% reflects the interest. But of course that's paid every year for 10 consecutive years at 9%, and the discount factor, the cumulative present value factor for these 10 years at 9% from the table in the question is 6.42. So consequently, the cumulative present value of the 10 years of interest is $1.605 million. Next, we need to consider the redemption cost. Now, we're told in the question that this loan note is redeemed at the end of year 10 at an equivalent of $1.20 per note. So the $5 million by $1.20. Now, at year 10, at 9% discount factor, we need to discount that future cash flow by a factor of 0.42 to represent the present value of that redemption amount. And that equates to, in total, $2.52 million. So the debt component, or the present value of the future cash flows in this case, equates to $4.125 million. Now, of course, the recipient of this instrument paid proceeds of $5 million. So consequently, as a balancing figure, we can conclude that the equity component of this instrument is $875,000. Next, we need now to look at the transaction costs, and now we need to split these transaction costs between the debt component that we've just calculated and the equity component that we've just calculated. So the total transaction costs are 3 cents per note, and of course there are 5 million notes, so the total transaction costs are $150,000. The debt share of those, again, we know that the debt component is $4.125 million out of a total debt plus equity of $5 million. So the debt share of those is $124,000. And the equity is represented by the balancing figure of $26,000. So transaction costs are now split, with $124,000 being allocated to the debt component of the transaction and $26,000 being allocated to the equity component of the transaction. Now let's look at the financial liability and specifically the amortization schedule for this. So with the amortization schedule, we're going to look at the interest expense that accrues each year at the effective interest rate. We're going to look at the cash outflows to offset this liability, and we're going to look at the net carrying amount on the statement of financial position. So firstly, the transaction was instigated on the 1st of October 2009. So initial recognition of the financial liability is at its fair value less transaction costs. Now the fair value of the debt component we've just calculated at 4.125, and of course the transaction costs that are allocated to this debt component are $124,000. So this gives us on the 1st of the 10th 2009 an initial carrying amount of $4.001 million for the financial liability. In the year to the 30th of September 2010, this debt component accrues interest at the effective interest rate. And again, the effective interest rate, considering transaction costs, we're told in the question, is 9.45%. So consequently, the interest that we recognize, and of course this goes to the P&L as an expense, is $378,000. Next, we pay some cash to offset that accumulated liability, and the cash that we pay is based on 5% of the par value of the loan note, and 5% of $5 million is $250,000. So the closing balance at year end 30th of September 2010 is actually $4.129 million. Now let's look at the equity component. And again, the equity component is recognized on the statement of financial position net of transaction costs. Now we've calculated that the equity component at inception of this instrument is $875,000, but the amount of the transaction costs that are allocated to that equity component are $26,000. So consequently, the carrying amount of our equity component on the 30th of September 2010 is $849,000. Thank you very much for tuning in to the MicroLearning Institute to look at the December 2010 Diploma in IFR question Epsilon.